Welcome. You're watching India Market Close, and what a Monday it has been for the markets. On a truncated week, the kind of confidence and sustained confidence we've been seeing in the Nifty is quite astonishing. Still managing to stay above the 24,600 mark. Let's just pull up the map for the day, the line graph for the day, just to give you an idea of how it's panned out for the Nifty. And while it has been steady state for both the Nifty and the Sensex, other key indices have not been that great. All right, so the advanced decline ratio, please, as we talked about. All right, there. So you have seen a sustained sort of strength in the market. Let's look at the market breadth for a second as well and see if that story pans out across the board, and possibly not. You have seen maybe not that kind of a strength, so you have advances beating the declines, but not by too much of a margin. IT stocks would be the big losers this afternoon. Started out very, very strong, but now seeing a bout of profit booking. And if you pull up the heat map, you'll actually see that entire trend continuing. HCL Tech, which was the darling of the morning, losing some steam there. LTI Mindtree right there on the sell side. Grasim, Asian Paints, Tata Steel and Asian Paints were languishing here at the bottom right from the beginning, but that story seems to have changed. What's instead taken over would be your PSUs, your energy pack, and some of those stories which are popping. ONGC has had an upgrade, a ratings upgrade. Perhaps that's why it's so excited right now. SBI Life, HDFC Life is the one which came up with numbers better than expected. SBI Life is following suit. Shriram Finance, SBI. So as IT is sort of seeing profit booking, you have the financials coming up to the fore. Bajaj Auto, a day before their numbers, are also doing fairly well. But you're seeing more green than red over here. Samina, one would reckon that the story is not necessarily about IT losing its flavor while you come to close. Financials taking precedence, and the broader market's doing better.
Yeah, in fact, this is exactly how the trend looked like this morning as well, right? Tech is in a bit of a profit-taking kind of mode. Remember, we've seen earnings, but we've also seen a run-up. These stocks have run up significantly ahead of the earnings. So if you borrow earnings from the future, you will see some profit-taking emerging. Mid-cap space is looking good. Broader markets are performing in line with the benchmark. So mid-cap, small-cap, and micro-cap are the three other verticals of the market that are showing strong gains this afternoon. Remember, we are outperforming the world, and that's what I would be taking heart from. Despite gaining for the last 6 weeks, Friday was strong, and today continues to remain strong. Let's take you to the pockets which are leading the markets higher this afternoon. And interestingly, auto is back in flavor, and so is auto ancillary. Tire stocks that have been on the sell side for the last 2 weeks are the small sector that's in focus this afternoon. Largely on reports, there could be a tire price hike coming their way. SEAT could have potentially undertaken that, and on back of which tire companies across the board are gaining. JK was up 12%. Midday, it's off the day's high point, but still trading with a 7% gain. SEAT is still up 4.5%, and Apollo Tyres holds on to a 4% up move in trade. Along with that, a whole bunch of other names that are in focus that we're tracking this afternoon. There was a report by Investec about how they're betting big on the travel boom in the country, on back of which VIP Industries and Safari were their two buy calls that came out. Along with that, banks have started moving higher. We'll highlight that for you in a minute, but all your banks are trading much higher in the last hour of trade as we see it. Inamdar reported numbers beat street expectation. The stock has been a darling of D Street for the last few months. It was up 60% this month, and the counter itself is up 3.5% as numbers have supported the kind of rally the stock has seen. Apart from that, Apollo Microsystem, they've been shortlisted for India Part 2, where they are working on futuristic drones for the Indian Army, on back of which the stock hit upper circuit. We caught up with the management. The management said they're looking at a 50% revenue growth in this calendar, in the financial year 2025, on back of which Apollo Microsystem trades the gain of 5%. Tanla Platforms is up 7%. Godfrey Phillip, not sure what's happening here, but the stock has been trading firm from the get-go this morning. It's been the top performer on the Nifty 500 and holding on to its gains as we see it, with gains coming in on fairly large volumes. Well, a few more to track. Zomato, they undertook a price hike, delivery platform price increase, on back of which the stock trades higher by 2% odd. Well, that's pretty much what the story is. Macrotech developers, it's the only real estate counter that's actually looking good in trade this afternoon, up 6% as we see it. But it's Godfrey, which is the top gainer, followed by that are tire companies that are looking good. All in all, the markets have found a reason to reward and to move up, and hence you're finding sector rotation that's playing out at its best today, Tamanna.
Okay, all right. Those are some of the companies that are doing really well. On Godfrey Phillips, I'm reading. We'll have to confirm this, of course, that they have launched small cigarette sticks in some markets, and that perhaps is giving a boost to the counter this afternoon. But you've been seeing that coming from quite a bit of time over there. Hemen Kapadia joins us today on the show of KR Choksi Stocks and Securities. Hemen, very, very good afternoon to you. Great to have you on. Let's start with how you're looking at the indices. 24,600, a comfortable position for the Nifty right now?
A very good afternoon to you, Tamanna. Thank you for having me on the show. It's always a pleasure. Comfortable, yes. Me, not so comfortable, because everybody includes me, we've been waiting for a correction for ages. No sign of that as of now. So everything is hunky-dory, copacetic, looks good, indicator support, all-time highs, mid caps, everything is fine, but one just gets the feeling that things are moving a bit too fast. There is a event risk at hand. I'm not sure if it's as big a event risk as it was in the years past, but yes, there is an event risk nevertheless. But yes, succinctly put, the VIX is at 14. I would have preferred if we were sub 13, but as long as it doesn't cross 15, it's fine. If it crosses 15, Tamanna, I think that would be the first indication of possible time to stay alert. But since the event risk is there, you expect volatility and the fear index, as you call, to spike up a bit. So that is somewhere built in. But yes, once again, succinctly put, everything seems quite all right and in place, despite the rise. No levels have been broken, no major negative divergences, so it's all good.
Yeah, hi, it's also Samina joining in. Let's talk stocks now. While, very often when the markets are expecting correction, that's when it usually doesn't happen, right? I mean, markets have a way of only doing the opposite of what the consensus agreement is. But Bank Nifty is picking up traction in the last 15-20 minutes of trade. All banks are trading higher. Do you feel like maybe if not the index, going long on Bank Nifty may not be such a bad idea?
I think that's a very valid point, Samina. Going long on the Bank Nifty is really not a bad idea, because okay, the Nifty has been making new highs on a regular basis. The Bank Nifty is playing truant, so to speak. Maybe now is the time. So yes, technically, things have improved, at least on the 60-minute charts and the 2-hourly charts, Samina. So above 50 to 800, I think we'll see more momentum coming in. But yes, I totally agree with your point. Makes sense to take a calculated call on Bank Nifty. I think it can play catch up. As of now, whatever we've seen is a complete revival in the PSU bank stocks. Their weightage is less, but I think if this translates into the Kotaks and the HDFC, then the IndusInd Bank's Bank Nifty doesn't seem like a bad idea at this point in time.
And specifically, apart from Bank Nifty, would you consider long on any specific stocks in the Bank Nifty universe, maybe for the week?
I think one of my picks is IndusInd Bank, Samina. We spent 6 trading sessions moving sideways, then between 14.15, 14.50. Indicators have turned positive, crossover buys, early to early charts are looking good, and the stock is deeply oversold. We've come up from 15.50. So succinctly put, I think IndusInd Bank is something which one can take a call on. I would say extend your horizon to maybe next week, because we have a holiday coming in on Wednesday, Samina. So one can buy IndusInd Bank at around 14.45, stop loss of 14.15, 1415, and target of 1505, Samina.
Okay. All right. Stay on with us, Himen. Let's just talk about HDFC Life for a second. The numbers came out a short while ago. It's gone off its gains. It's lost some of its gains, up still about 1%. The company's profit and income rose 15%, while VNB margins took a hit. Harsh joins us with the details. Harsh, is there enough for the street to celebrate at all?
Not really, Tamanna. It's a mixed bag when you're looking at it. First off, just with regard to top line, good growth, much better than expected, maybe 2-3% better than expected. So not much, but better than expected nonetheless. And mind you, the base was higher because most analysts had already revised their estimates basis the April to June quarter. Basis the numbers, the preliminary numbers which came out, and that kind of maybe 2-3% better than expected. When you're looking at individual APE, right, that came in very strong, 30% plus growth on the individual APE side. So individual is where all the growth is actually coming from. You're looking at VNB growth, which is at 18%, so slightly lower than expected, but you're looking at VNB margins which have come in at 25% because of the VNB number which has come in largely in line. The margin number, because the top line is better, the margin number has come in slightly lower than expected. So your profitability is compressed, but your top line is much better than anticipated. That's really the essence of it. Now, in terms of what is growing, individual is growing very well. You're looking at ULIP growth, which is also expected to be better than expected. Just in terms of that growth number, ULIPs is what is driving that growth, and because ULIPs is a lower margin product, that's what's impacting the margin number overall. Just in terms of the other numbers, you're looking at Indian embedded value, which is at roughly 49,600 crore, which is now valuing HDFC Life at 2.8 times embedded value. The growth on the embedded value is 19%, so very strong growth. The persistency ratios really stood out for me, 87% on the 13-month persistency, but really the 61-month persistency is what really is standing out. 56% versus the 53% number same time last year. So they are working on that persistency number. They are looking at business more from a long-term perspective. At least that's the essence of it at the moment. Commentary, of course, awaited.
All right, so commentary waited for HDFC Life. It's a mixed bag. The value of new business and that margin is a little squeezed. What about Bank of Maharashtra, Harsh? The first cut that we saw looks good. The stock is up as well. NII is up 20%, net NPA change, net profit up 47%. Have you had a chance to look at those numbers? Now up about 6.5%, up over 6% as we speak.
Well, so Tamanna, the growth seems very strong here, especially on both the NII front as well as on the profit after tax front. Just in terms of, the growth in the business itself, we've seen slightly less aggressive growth, 13.5%. The book size is larger, mind you, but largely that's where the business has grown by. 9.5% on the deposit side looks okay-ish, nothing fancy, but the GNPA ratio compression is definitely strong. The net NPAs is now at just 0.2%. Not too many banks can boast that, even within the private sector. So essentially, it's time for recoveries to continue to kick through, which is possibly the one big positive that I look at. In terms of the operating profit, the growth is very strong, 23% growth, and that too driven by recoveries likely will continue to keep the stock or the profit after tax in a good zone, in terms of in an elevated zone, and therefore that positivity is likely to continue to trickle through. The cost to income is below 40%, so that no worries there, but the ROAs are at 1.7 and inching higher. Now the ROA number, if at all were to inch towards that 2% number, you will start to question something like an HDFC Bank, which also does 2% on ROA, and Bank of Maharashtra, which also does 2% on ROA. So you'll start to question some of those numbers. HDFC Bank ROA of roughly 1.8, 1.9% versus Bank of Maharashtra at 1.72, clearly reflecting that the number is very strong.
You're absolutely right. Who would have ever thought we'd ever be making that comparison between a Bank of Maharashtra and the big daddy HDFC Bank? G. Chokalingam now of Equinox Research now joins in. Choka, what did you make of HDFC Life's numbers? The street is enjoying what they're seeing. And of course, I believe the money, the business growth has come from ULIPs. Low margin but high sort of top line focus. ULIPs usually is a business that the regulator doesn't like very much. So hence, it's a catch-22, I'd imagine.
Yeah, certainly I agree with that. Definitely. But, its result is not that bad. Actually, if you look at the PBT on year-on-year basis, the HDFC Life has posted nearly, little more than 19.4%. Even Q-on-Q, 10% rise in the PBT. So tax provision which has spoiled growth, compared to last year, more than tenfold jump in the tax provision. That's what spoiled ultimately at the bottom line. However, one small concern with HDFC Life of late is that it is not able to grow its profit consistently. The growth momentum keeps fluctuating widely, but certainly, considering the current market condition, one can definitely buy or hold HDFC Life since it's a part of Nifty, and I believe there is a lot of scope for Nifty and the Sensex to further move up 8 to 10% in the current calendar year.
Right. Also, Choka, you want to come in on banks as a whole pack? They've had a good run and they pretty much led the way in the month of June. Then we went on to the back burner for the last couple of weeks. But today seems like a day that they're making a comeback. We've seen numbers from Bank of Maharashtra and those look pretty impressive, to say the least. Keeping Bank of Maharashtra, even though I agree that it's a smaller bank, as a queue, how would you approach the banking pack, and are you constructive on any of those banks ahead of earnings?
Certainly. You can't ignore the banking sector, but still it's one of the largest sector in the Nifty, or even the Sensex to some extent. I am quite bullish on the banking sector. Interestingly, the monsoon, about 2 weeks back, it was quite pathetic, monsoon performance. But last few days, it has become, absolutely normal as per the statistics definition of IMD. The deficit is only 2%, which was more than 12-15% about a week or 10 days ago. Even the number of subdivisions have received a good rainfall. So it means a lot for the banking industry because we were all hoping for a rate cut, and we had a concern on monsoon. Now, since monsoon has become normal, I'm pretty confident that the retail inflation will fall and ultimately the RBI will start the reverse cycle of the interest rate. That should help the banking sector. Secondly, even when monsoon was not that great, most of the institutions have projected 14% credit growth year on year for the banking sector. So last year and this year, there's a remarkable growth for the banking sector because post-COVID, the credit growth came down as low as even 5.5%. Now strong double digit, all this should help. And I am bullish on Kotak Bank because I believe that the unlocking just started with one insurance firm. Still they have more than 7-8 large 100% subsidiary, which market people give a valuation of about 1 lakh crore only for subsidiaries. So I believe there will be a lot of unlocking potential from Kotak Bank, and followed by HDFC Bank. Though it has become a little dull stock, still I like HDFC Bank. I believe there is unlocking potential from NBFC, and the bank will continue to post 15 to 18% profit growth at least for next 3 to 5 years. Thirdly, I looked at Bank of Maharashtra. In fact, we initiated, at less than 20 rupees, and we closed quite a while ago. The profit growth is fantastic. No doubt. But the business performance of first time in the last, 4 to 6 quarters, it is quite disappointing. If you look at advance growth year on year, it's a very poor single digit. It is not the style of Bank of Maharashtra. So that is a concern. Whether this kind of year-on-year profit growth can continue, I doubt. But yes, maybe for long-term investors are good, but short to medium term, I think the price is, fairly valued at the current book value, adjusted book value.
That's the word coming in on banks, and they're too big to ignore, like Choka said. We'll take a break. We'll come back. On the other side, we'll put the focus on Zomato as they increase platform fees. The stock is one of the top gainers in trade, and of course, also get Karan Tarani to share his view on Zomato.
watching India Market Close. Another stock in focus is Zomato. Shares of the company rose after platform fees were hiked in two cities to 6 rupees per order in Bangalore and Delhi. Rishabh has all the details. Rishabh is also telling us how Zomato rival and soon to be listed Swiggy has also increased platform fees.
Right, so food delivery giants Zomato and Swiggy have sort of teased and hiked their platform fees across various key markets. Now, across Delhi, NCR, Bangalore and Mumbai, which are the top three markets in the country, Zomato has hiked its fee to about 6 rupees per order from the earlier 5 rupees per order. That's about a 20% hike. And in other key markets, Swiggy has hiked and rather teased a 7 rupee fee, which it currently shows discounted to rupees 5 per order. Now, this is again in line with the growing quest for profitability. We've seen Zomato grow leaps and bounds over the last 4 quarters. We're seeing Swiggy head for an IPO, so obviously it wants to head for improved profitability metrics, and a key factor of that is that mandatory platform fee. Now, platform fee, for those who haven't heard of the term before, is a flat fee that is charged by these platforms that is separate from the GST, from the restaurant charges, the handling charges, and the other sort of miscellaneous terms that are levied when you order food from online delivery platforms. In fact, in its March quarter letter, Zomato had also stated that one of the key reasons for their improved profitability and improving margins is the introduction of the platform fee. Platform fee has been used as a tool for sort of having that sort of boost to the top line. If we look at the number of orders that they do, Zomato being a listed entity, we have the number. In FY23, they did about 65 crore orders. Now, on these 65 crore orders, if you levy a platform fee that is increment of 1 rupee, that is an additional 65 crores to its top line across the year, which is a pretty big number. So an interesting trend. Analysts have predicted platform fees to increase as we go ahead. So there is more room for growth here.
All right, Karan Taurani, SVP of Elara Capital, joining us now on the show. Karan, good afternoon to you. I know this is a stock that you've been tracking very, very closely. I think what's interesting is that Zomato has increased its platform fees 3x since nearly a year, since August 2023. And it doesn't seem to have made any difference at all to their order volumes, isn't it?
Hi, Tamanna. Good afternoon. So yes, I think, it all started off last year around August when they started charging platform fee. It started at 2 rupees. Then it was a phased increase across various cities, went on to 3, 4, 5, and now they've come to 6. There is no impact of this on order volume, for the sole reason that this is coming in a phased manner, right? So if you look at the AOV for a company like Zomato, the AOV in terms of the food segment would be almost about 400, 420 rupees. Now, even if the platform fee goes to 10 rupees, over the next year or probably 2 years down the line, it will not be more than 2.5% of AOV. So I think this is done tactically and strategically to improve margins in a phased manner, to make sure that the customer does not feel the pinch of the entire hike at one point of time. And if you clearly see, this is being tested across various cities first, and then, basis response is implemented in other cities as well. So it's a very good tactical strategic move which is being done. And last but not the least, I think this is also a way to offset negative impact of the free delivery. So if you know Zomato, they've started loyalty plans, Zomato Gold. So, free delivery means that Zomato has to bear the cost of delivery and the customer is not being charged anything for delivery. So delivery charges generally from the customer side was around 30 rupees, before the Gold plan. And I think this is also some way to offset the negative impact of free delivery, from the customer via a platform fee in a phased manner, so that you can get an improvement in terms of margins in a steady state.
How higher will they go, Karan? What is your assessment? I was seeing your note, and you think that they'll go higher as 10 rupees, 8 to 10 rupees per order, because they're increasing it in small increments, and it's being absorbed pretty well by the customers.
Yes, absolutely. I think if you look at the general inflation, I think we are staring at an inflation of about 3 to 4% in terms of AOV. So incrementally, that benefit is already coming in Zomato because the take rates are somewhere fixed to percentages. But if you look at the inflation in terms of cost of delivery, I think we are seeing higher inflation there, about 8%, even 10% for the order in terms of fulfillment. So, and in the midst of everything, if you want to drive frequency, because clearly what was happening earlier with all these new age companies is that they were focusing on customer addition, they were focusing on adding new customers. But if you have to get profitability, if you have to get better margins in the business, you have to drive frequency. So I think frequency is a very big lever for all the internet companies, including Zomato. And to drive frequency, they started introducing plans like Zomato Gold, wherein the delivery is free and people are trying to order in more frequently. Now, if they do that, there is no way that they can get delivery. So they are rather, increasing platform fee in a phased manner. So the customer does not feel the pinch of it, and the customer also is able to, order the food more frequently. And that will eventually drive Zomato profitability as well. So it's a clear strategy when they want to focus on reasonable growth with good improvement in margins as well.
Now, can you quantify what the impact of an increase in platform fees on margins? If we are working with going from 6 to 10 in the medium term, how much better will the margins look?
So see, tactically, in terms of historically, what we've seen is that the margins have got multiple levers, right from advertising revenue to increase in commission rates to hiking of delivery charges, and platform fee is another lever which is there. So two levers out of this right now, I don't think will work going ahead. One is increase in terms of commission rates or take rates from restaurants. I think somewhere we've plateaued out over there. I think the take rates somewhere are about 18-19% extra delivery charges, and we don't see increase beyond this. In terms of restaurants paying more in terms of commission rates. So that is not a big lever as such. Second thing is in terms of delivery charges. Again, there we don't see much of an increase because most of the traffic or most of the consumption would be driven by the loyalty plans where the delivery is free in nature. So in that case, you're left with two levers. One is the platform fee lever and the other is the ad revenue lever. Now, what this does in terms of potential margin impact is that, 1 rupee increase in platform fee has about 7 to 8% absolute EBITDA upgrade. And it has a positive impact of about, 15 to 20 bips in terms of your take rates and about 20-25 bips in terms of your potential EBITDA margin as a percentage of GOV, as the company probably reports. But this happens when the when the platform fee is taken in a blanket manner across various cities. Now, if you look at the scenario here from last year August until this year July, the platform fee has been increasing in a phased manner and in multiple cities in different phases. So it's very tough to quantify the exact impact this kind of thing will have in terms of the platform fee from 0 rupees to 6 rupees over the last 1 year. But I think we believe that even if let's say that platform fee on today on a pan-India basis on average is at 3 to 4 rupees, I think there is a potential positive impact of 15-20% on the EBITDA, which we are clearly seeing, and even the margins have seen a significant increase. So I think platform fees are a very big lever apart from the ad revenue lever to drive margins from here on.
And that's a reflection of that is very obvious on Zomato, the stock, which trades at its record high with a 3% gain. Karan, very lastly, some argue that the stock is expensive. Others believe it's Swiggy's expected listing around Diwali time. Zomato may not be your only preferred play in this space. How do you feel? Expensive, yes or no? And how does it compare to a Swiggy, which is going to be listing shortly?
So obviously the stock is not cheap. The stock is expensive, but you also have to see execution here. So the company has outperformed on all parameters as far as execution is concerned. If you look at their growth rates, if you look at their market share gain in the food segment, if you look at their path to profitability, they've always given a certain guidance and they've kind of beaten the guidance. They've kind of got better margins as compared to what they're guided for. It's done in a more faster and quicker manner. If you look at the quick commerce segment, therein they've gained market share, they're market leaders, execution has been very good. They are the only players who have reached a break-even, largely break-even as per Q4 numbers on the quick commerce side. Other players are still making hefty losses. So I think the stock valuations are expensive, will remain expensive, but it's a clear compounding story. If they continue to execute well, I think these premium multiples will kind of roll over year on year. And you will see a good 25-30% return every year on the stock, even if it appears to be expensive. The second thing is on the Swiggy IPO part. I mean, of course, Swiggy IPO will, keep, both of them on toes rather, Swiggy as well as Zomato. But Swiggy, we actually yet to see a turnaround. If you look at the last 2 years, whatever has come in public domain in terms of financials or in terms of numbers, it has been very much below par as compared to a Zomato. So if Swiggy does get listed, obviously they will get listed at a discount versus Zomato's valuation multiples because, in terms of Instamart, the market share is low. In terms of growth rates, they are not as superior as Zomato. In terms of profitability, again, the food business is not as profitable as compared to Zomato. So they will be given a discount of 25-30% versus Zomato. But if Swiggy is to execute well, if Swiggy, we see a potential for gain market share, we see a potential for improvement in margin, we might see a multiple rating over there as well. So obviously, both companies are going to be on toes. But as of now, Zomato has the upper hand, and that will continue in the near term.
Right. Thank you. For now, it has got an upper hand, so it's best to enjoy this rally while it goes through its journey. Thank you, Karan. Always good talking to you. We'll take a quick break. We'll come back, put the focus on auto and auto ancillary. Tire stocks having a field day today. And of course, it's all eyes on Bajaj Auto as they report earnings tomorrow. So stay tuned.
Welcome back. All eyes on HDFC Live. The press conference post the announcement of their Q1 numbers is also on right now. Let's listen in.
0.2% for financial year 2024 and is projected to grow at 7.2% during financial year 2025. This compares with a GDP growth of around 4% for all emerging markets and an even lower growth for the developed markets. The onset of the Russia-Ukraine war in early 2022 saw spiraling oil prices and inflation started hitting the Indian economy from April of 2022. RBI successfully reined in inflation through a series of calibrated measures. Core inflation has largely been reined in and stood at 3.13% in June 2024. In my opinion, both the government as well as the RBI did a truly outstanding job in managing the economy during the last 4 years. This has contributed significantly to making India the fastest growing major economy in the world.
Well, that's KK Mistry addressing a press conference as they report their numbers. But let's shift gears and move to tyres. They seem to be doing quite well in trade today after taking a breather for the last 2 weeks. Puneet is standing by to tell us what's going on in this sector. Puneet, last week was about a slowdown in the auto sector, and today is about price hikes by tyre companies. It's interesting, isn't it?
Yeah, definitely, Samina. It's a very interesting trend that's happening. Most tyre makers are up between 5 to 9%, and this is on the back of media reports of speculation that MRF might be looking to do some price hikes on the July 18th. Now, they have said that roughly the truck tyres will see a 2% price hike, while the passenger carriers as well as the PV space is going to see a price hike of roughly 3 to 7%. Now, do note that MRF was the only player which hadn't done any kind of price hikes in the last 2 quarters. So this is of course a welcome change of the industry now that the differential in prices between the other players as well as MRF will be quite lesser. When you look at the previous price hikes that most companies have done in May 2024, around the Q1 conference calls that they had also had, management had said that Apollo Tyres had done a 3% price hike, while someone like a SEAT had also taken a 2% price hike. In the conference call, Apollo Tyres had also mentioned that, these price hikes which are just the starting point in Q1 will see a little bit more and see any kind of impact such as EPR provisions, which we had seen 100 crore impact last year for most tyre makers, as well as the increasing raw material prices, especially of natural rubber that we've seen since the start of the year in January 2024, should be mitigated. Going forward, depending on how the pass-through has been of the commodity, they will eventually decide on that as well. When you look at MK's note on the tyre industry also, which had come just a couple of weeks ago, they had mentioned that their intensive channel checks had 3 key observations. The first one is, of course, that the fundamentals of the trucking industry has improved substantially, which augurs well for the tyre makers. They've also said that Indian tyre makers are closing the gap with the international peers and MNCs. And finally, they have mentioned that the demand as well as the premiumization should offset any kind of raw material price hike or EPR hit. So overall, the positivity does continue, and we will be looking out for more commentary by these managements in the Q1 results of FY25. Back to you.
It's in a sweet spot. We'll get a view on tyre companies from Himain and Chakri as well. But just before we go into that, we'd caught up with Manav Chopra a few weeks ago, and he was very constructive on tyre stocks. And we spoke to him today, listening to what he believes in terms of the outlook on some of these tyres like JK and Apollo.
Tyre as a space, within the autos, auto as a sector has been very good, has witnessed a very good bull rally since October 23, and there has been certain pockets within the subsector of autos which have seen some bit of a correction, and tyre as a sector has formed a very, very strong base formation. Over the past few weeks, we have witnessed very strong accumulation pattern happen post the decline of 10-15% in individual name. My pecking order is Apollo Tyres and SEAT, and we expect new highs coming into this stock when we are also looking at the international rubber prices. My sense is the international rubber prices are also on verge of peaking out. Also, crude has come to a point where you will see some bit of a resistance and cool off coming in the next few months, which could act as a reasonable tailwind for tyre names in general. And recently a short-term breakout in tyres with volumes. I think all these confluence together indicates a very strong run-up rally which is likely to play out. And in that case, we've given an upside target of 3,700 in SEAT, which is still 30% from current levels. And for Apollo Tyres, my target stands at 720, which is like a 35% from current levels. So we see a reasonable room coming to these names, backed by very strong, larger uptrend, which is still intact.
Right, long-term intact is the view coming in from Manav. Himain, for a weekly view on, because I'm sure that's what the traders are most excited about, would you buy Apollo or JK at the current market price after the recent rally that they've seen for the week?
So, in fact, Samina, I have a buy call on Apollo Tyres today.
Interesting.
At 540, stop loss 520, target 580. We've had a 13 trading session consolidation phase between 517 and 550. We have seen a big volume spike. Volume is higher than the last 10 trading sessions or so. The indicators are supporting the move. And if you look at the weekly and the monthly charts, we were in a correction in a bull market. So I believe there is further upside left, and the long-term charts remain completely well set for a further upside. MRF is one which also looks interesting. MRF has formed a rounding bottom on the weekly charts. It's a bullish formation. So I guess I have a buy call on Apollo as a trading buy, but many of these tire stocks are looking good to me.
Okay. So Himanshu still bullish on tire stocks, but that's not all that's buzzing. Look at Bajaj Auto in focus today, and Bajaj Auto has revved up the Nifty chart as a gainer also because of its numbers, which are due tomorrow. Puneet joining in for what is expected not just from Bajaj Auto but from the entire auto pack. Yes, Puneet.
Yeah, thanks for that. So two-wheelers are definitely going to be the flavor of the season. Most two-wheelers are expected to report very strong numbers, and Bajaj Auto is definitely one of them. Revenue growth expected between 14 to 16%, while EBITDA growth is going to be very strong, coming in at 20%. Now, of course, the CNG launch as well as what the other strategy that the company is following in the 125cc space is going to be one of the key things to watch out for. Apart from that, TVS is also expected to report good growth at 18% in revenue, 15% in EBITDA, but Hero MotoCorp is going to be one of the strongest players here. We have seen surprise positive sales growth in the month of June, which was very unexpected. It's a very low month generally for the rural players, but we saw good sales growth coming in, and they've also been taking market share from other players in the 125cc space where they've been largely absent over the last 3 to 6 months. Aisha Motors is going to be disappointing again in this particular quarter, and management commentary is going to be key. When you look at the passenger vehicle space, of course, Mahindra & Mahindra is going to be one of the top tier automakers to report strong growth, coming in at 18% of revenue and 26% of EBITDA growth, while someone like a Tata Motors and Maruti overall is going to be a 5 to 7% revenue growth range, while EBITDA growth is going to be the season. So overall for passenger vehicle makers, margins are going to be one of the key stays, and most of them are going to be reporting positive margins. For commercial vehicles, it's going to be a very dull quarter. Ashok Leyland specifically, if you look at it, the volume growth has been around the 7 to 8% range, and that is also on lower base, so it's not been very positive. When you look at, both ICICI as well as Nomura is expecting just 6 to 7% revenue growth for Ashok Leyland, and also seeing sequential margin decline due to operating leverage, which is not going to be working in favor of them. And tractors is going to be a subdued quarter again in this one. We are seeing any kind of recovery in the second half. So specifically, two-wheeler makers are going to be very positive, and margin story for the passenger vehicle makers. Back to you.
Thanks for that, Puneet. That's the auto sector and those earnings that we're expecting. Chakri, Choka, what is your call on Bajaj Auto ahead of the earnings? Would you be brave enough to take a position on Bajaj?
If you permit me just 1 minute, I made a mistake on Bank of Maharashtra. The year-on-year credit growth was 19%, not poor single digit.
Oh, thank you for that correction. That's useful, yes.
Poor single digit growth was for Q on Q. But still, the stock is trading at 2.6 times adjusted book value, which is historically at a huge premium. So therefore, the stock is suitable only for long term. Now coming back to two-wheeler, SUV, these are the only two segments are still growing in a robust manner. So therefore, all those who are holding two-wheeler stock, they can continue to hold. Post the results, so one can consider adding them.
All right. So specifically on Bajaj Auto, Choka, are you excited about Bajaj Auto?
It's a hold because you need to see how the export sales are improving.
Okay.
So currently, I would give a hold call on Bajaj Auto.
Himen, your take on Bajaj Auto?
Actually, Tamanna was good, is good, remains good. Currently, a consolidation correction is ending. I believe we're going to bounce again and continue the move.
Okay, so Himen continues to be constructive on Bajaj Auto. Just another stock that actually I want Choka's view on is Raymond. Now, Raymond has been active for last few sessions and both ways, right? Today is up 5% again. A lot happening in the company with the demerger, what's happening with the family, the management. Are you seeing anything that makes you hopeful of a Raymond, Choka?
Well, it's really congratulations to shareholders of Raymond. It has really done exponentially well in the last 2-3 years. Since I am a little conservative, I would not buy. Rather, I would recommend a similar stock like Nesco, which is also a land bank story, and I personally hold it. It's sitting on 70 acres of land in Goregaon. So that has not played out. So normally, being a conservative, I look at a stock which have not played out rather than stock which have multiplied 5-10 times. So I would not recommend a buy on Raymond at this price.
I mean, you saw what happened or what's happening on ONGC this afternoon. I mean, sharp spike in holding on as we see it, 5% on Nifty 50 company. If you're a swing trader, would you consider going long on this one at these levels, buy into the strength?
The stop loss becomes deeper, Samina. There's nothing wrong with it. It's in an uptrend on all time frames. So all systems go, ticking all boxes technically. But the swing low was 288. We're at 322. But like you said, an FNO stock, I believe the stop loss could be deep. Risk-reward ratio might not be in sync. But yes, if you were to trade, keep today's low as the stop loss. There's nothing wrong. All-time high, no known resistance level, clear blue skies. Everything is hunky-dory. It's just that it's moved a bit. So maybe, and we have a holiday coming up.
Quickly, just following up on that, Himain, what about GAIL? I had a few buy calls this morning on a few other shows where GAIL was seeming attractive from a 1 to 2 day time horizon. Do you agree? Do you like GAIL in the oil and gas pack, if not as euphoric about ONGC?
Yeah, I think GAIL looks good, Samina. It is in an established up move and continues to do so. In fact, if I could just add one more thing, IGL could break out above 540 in the next 2 trading sessions.
Okay, GAIL looks good. ONGC looking interesting. IGL looks good. I mean, I would add, quite a few from this space, which are showing a runaway trade this afternoon. But another stock that has caught my eye is Shriram Finance. And let me come to you on Himain, that entire banking pack. Let's talk about Shriram Finance for a second as well. How much of an up move are you seeing further on the NBFC back and Shriram Finance?
As far as Shriram Finance is concerned, Tamanna, a 15-14 trading session down move seems to have exhausted itself. We are in the throes of a comeback. So if I were to look at the long-term charts, I mean, no rocket science required, remain safely ensconced. Longer term up move. Near term, we're looking at a recovery, not a rally. But looking at the overall setup, it gave a correction, 2200 to 3050, retraced the move by coming to 2700. Looks good again. So now 2700 with the swing low needs to hold. I believe we are heading towards 2940 and about 2940. A test of its all-time high at 3060, Tamanna.
3060 is the limit that he's seeing on Shriram Finance. Well, that's another interesting one today. I don't know, Choka, what are you making of the entire banking space right now? And would you create any fresh positions?
Certainly, yes. As I mentioned earlier also, with a good monsoon, I'm pretty confident that inflation rate will come down, the interest rate cycle will reverse, and the banking sector will be the beneficiary. All rating agencies also forecast 14% year-on-year growth in the credit, which is still second highest, in the last 10 years. So all this would favor banking sector, and the topmost pick would be Kotak Bank, followed by HDFC Bank. These are the two large cap banks, banking stocks I strongly recommend.
Okay, so HDFC Bank and Kotak Bank are your two top picks. Or another sector that we're tracking this afternoon is IT. Remember, IT started off strong. After a fantastic Friday, you still had an up move in this morning, but the Nifty IT is sliding off today. And the sector under pressure even ahead of big numbers yet to come. Remember, we've heard from TCS and HCL Tech, but a lot more expected to come. We have to wait and see what Infosys does, what Wipro does. Now, Investec has a call on Indian IT service companies. Rucha is joining us with the details. Yes, Rucha.
Thanks, Tamanna. So you're right, Investec has come out with a note on the India IT services. Now it believes that basically in the current scenario, the sector is celebrating lower revenue leakage on the deal book. Now this was the problem with the Indian IT services, wherein deal wins were not getting converted into revenue, which is largely not the case in the first quarter of FY25. And the brokerage house also believes that a big recovery is expected in 2025. Now talking about the ISG index. Now ISG is the house which is tracking IT on a macro level, and on its call last week, it mentioned that there still is continued weakness in the discretionary spending, and the managed services segment continue to be down in the America and the Europe, and it also cut its growth forecast for managed services to 2% versus 3% earlier. Now talking about the BFSI sector. Now the BFSI sector, most of the IT companies get majority of its revenue from the BFSI sector, and the large deal activity in BFSI is still down. Remember, TCS and HCL Tech both reported a YOY decline in revenue in these segments. Now, the hike in July 2023 is currently flowing. The interest rate hike by the central bank is currently flowing in the sector, and that is why we are seeing low activity in this sector. Lastly, talking about generative AI-related projects increased 61% versus the prior quarter is what the brokerage house believes. Now, this is basically on a small base, and therefore growth should continue to be high. Now, this will largely act as a revenue potential for Indian IT companies once they start converting these deal wins into revenue. And it also believes that AI is masking the broader weakness, even though a small portion of revenue. But all in all, when we checked most of the brokerage house reports, they believe that discretionary demand pressure is behind us, and 2025 is likely to be the year for recovery for Indian IT companies.
Thanks, Richa, for that. That is a complete view of Investec on IT, not seeming as excited about the sector. Is there more steam left in the IT? Should we invest now or catch the momentum? In fact, Tamanna caught up with Manav Chopra. You heard what he had to say about the tech stocks, and we'll get a view going from Himain and Chukalingam as well.
IT was one of the most unfavored sectors. Mainly, it has been a major underperformer, and that's where we witnessed that largely IT has been on a larger uptrend. Our long-term model that we run, usually which indicates an early trend mover advantage that we got, and basis on that, we looked into the broader formations where IT has been massively underowned, and one of the large cap sectors which is massively underowned and is basing out and then showing some structural changes. When actually things starts to play out in favor of any fundamental confirmation, the index has already sees a good run up, and I think that's exactly what has played out at the moment. But talking about the present and what we look going forward, I think we've seen a very, very strong run up coming into this space. But one thing we shouldn't forget, that majority of the mutual funds to our last study indicates that majority of them are still underweight. So a frontline sector which is majority still underweight, and the kind of results or the previews that we are getting, and any shift in terms of the guidance or the parameters, once the mutual fund starts to chase the frontline space, I think that leaves to another strong leg up coming in. And the kind of a run up that we've seen recently, the way the IT index has breached its Feb highs with a lot of stocks showing strong cash led buying, I think there is a reasonable room still on the upside, and we still foresee IT index going towards the 42,000-45,000, and the coming 3 to 6 months should be very good for the IT index in general.
All right, so interesting, because Manav had an earlier call, a June call on some of the IT companies, Persistent, Infosys, InfoEdge, TechM among them, and he continues to see a further upside there. Himain, let me bring that question to you. I mean, do you see what we're seeing today as a temporary breather?
Yes, Tamanna. I don't think it's very surprising, because if you check out the Nifty all-time high posted in Jan 22, Tamanna, it was 39,446. Today, we've come back to that same level after almost 2.5 years, 39,567. So on this range, 100-point difference is minimal. So we face resistance at its all-time high with a natural consequence, and that's why we've cooled off from an intraday point of view. but the setup is positive. We've taken almost 2.5 years to get where we are and consolidate. So, and we're on the cusp of a breakout. Why I'm saying cusp? Because we need a closing above the previous all-time high on Friday. Ideally, the end of the month, but markets are so dynamic. Waiting for the end of the month would be too late. At least a weekly close above the all-time high, I think, should mean a distinct further upside in the offing.
Right. Well, Choka, what do you feel about IT? Do you feel like they're topping out for now? We've seen numbers from HCL and TCS. While the market did get excited about TCS, fact remains that expectations were low and hence these companies have outperformed in that sense. No material recovery or green shoot yet in sight. How do you feel about tech? Is it just a value buy? I mean, they may not even be anymore after the run-up.
I completely agree with you. It is not going to improve from 2 to 4% dollar revenue growth to 8 to 10 or double digit, far away. But still, we were also bullish on IT stocks like Infosys, which is still our top pick. From defensive perspective, one should hold on to large IT stocks like TCS, Infi, HL Technology. Selectively, one or two small cap one can pick up. The norm is that you see that enterprise value or market cap to sales is around 2 times or around 20 PE, because the IT sector is likely to post a poor single digit growth. Therefore, I am expecting 1 or 2 more acquisition in the IT space, possibly from the listed companies. So therefore, we continue to be bullish on selective small cap IT stocks. So recently we recommended Axelia Solutions. It posted a year-on-year as well as quarter-on-quarter significant growth in profit recently, and trades only around 20 PE, and it's MNC stock. So that kind of approach investors can follow, but stay invested in large IT stocks, at least till post-budget.
All right. Thank you so much for that, Chokha and Hemen, for joining us today on what has turned out to be quite a pleasant afternoon, I would say, all things considered, and after the kind of run-up that we saw sustaining through. All right, just about 2.5 minutes left for markets to close. Let's take a look at where we are positioned, not quite making the cut at 24,600 on the Nifty, but I wouldn't say this is any major profit booking. You have seen a market which has maintained its inherent strength and robustness. Let's just pull up the advanced decline ratios just to give you a sense of the market breadth, and that has narrowed towards that end. You have seen the market breadth narrowing as we're going in towards close. Let's take a quick look at the heat map as well to see what's happening there, and the winners of the morning have not sustained at all. ONGC has climbed up those charts, up about 5%. Remember, they've had a ratings pat on the back. Maybe that has helped to some extent. It's about autos and it's about financials. SBI Life, Shriram Finance, SBI, all doing well over there. Bajaj Auto running ahead of its numbers tomorrow. So is Hero Moto up in the green. On the losing side are LTI, Mindtree, Tech Mahindra, TCS, all the winners of the morning really. Grasim and Asian Paints, both paint companies on the consumption play, perhaps, Samina, seeing quite a bit of pressure. But in the broader markets as well, it's been a tepid kind of a day, apart from, of course, your tire stocks zooming up, and those pockets of interest. I would say that.
I think some of the markets have spoiled you. It's 170 points on the mid cap and small cap index. So yes, not bad, I would say, especially after what Friday's the markets witnessed, right? So it was 186-point gain on the index on Friday. Follow buying looked unlikely this morning, but we've defied all trends and continued to go from strength to strength. Mid-cap, small-cap and micro-cap all up and about, outperforming the benchmark in today's day of trade. Well, lots of sectors stood out, smaller sectors. So while defense and railway and fertilizers, which have been the big theme over the last few weeks, took a backseat, what actually gained today was banks, and banks came out of nowhere in the last hour of trade, with likes like Bank of Maharashtra posting good earnings, spreading that euphoria across the banking space. Along with that, media was up quite sharply on Friday. Today is no different. The follow-up buying continues across media stocks. So while IT saw profit-taking, media continues to do well. Tamanna mentioned how auto was doing well. Tires were doing exceptionally well on back of a price hike being undertaken by the likes from MRF and SIAT. Remember, there's also a very aggressive buy note on JK Tires, where the brokerages are expecting the company's price to go up to all the way up to 700 rupees, and that was reflected in the stock price movement today. Pharma did okay, so that space continues to see buying interest. We haven't really seen any pharma earnings, so euphoria may continue up until pharma companies report numbers. For today, another positive day, 1% on pharma stocks. Your whole host of broad cap pharma names did quite well in trade today. So oil and gas, pharma, banks, railway, pardon me, I'm so used to saying railways.
Not railways. Railways took a breather today.
Have done well, and I think it's a pretty, oil and gas is up 2%. So it's not just ONGC. From the broader markets in Mahanagar Gas or GAIL, all of them doing quite well. So I think all in all, it's a happy Monday.
Yeah, not bad at all. HDFC Life, Bank of Maharashtra came out with numbers. Both greeted well by the street. So that's all the time we have this afternoon, really. Markets have closed decently. And we'll take a quick break here from Samina, me, and the team that put the show together. Thank you so much for watching. But stay tuned. A lot more coming up on NDTV Profit.
and welcome. You're watching an NDTV Profit special on the budget. Now, the countdown to the budget has begun. So what are markets going to be watching out for most on budget day? That's on July 23rd. So to start off with, the first figure we're going to be watching out for is, of course, the fiscal deficit. Now, the government in its interim budget had set a target of 5.1% of the GDP for the fiscal deficit. This time around, there is a chance that the government will either stick to the target or that it will revise this target slightly downwards. Now, not just the target for FY25, we're also going to be watching out for what the government has to say on the fiscal consolidation path. That's the fiscal deficit figures in the coming years for the next 2 to 3 years. It needs to consolidate the fiscal deficit further, and that has to be done without having to compromise on capex. So that brings us to the next big figure we're going to be watching out for, how much the government allocates to capex. Now, the capex budget, in the interim budget, the capex was targeted at 11.11 lakh crore rupees by the government. Once again, there is a slight chance that the government might actually retain this target or that it might modestly revise this target upwards. But what else we are also going to be watching out for is revenue expenditure. Now, revenue expenditure was allocated at 36 lakh crore rupees in the interim budget for FY25 by the government. Here, there is actually a chance that this figure too could see a modest hike. That's going to happen if the government chooses to allocate more to social security and welfare schemes, especially in a bid to drive up consumption, more so in the rural areas. This can be done by higher allocations on schemes such as PM Kisan or NREGA. Another way to do it would be to increase allocations or introduce new schemes altogether here. Now, given the fiscal math, another figure that we're going to be watching out for is gross borrowings. The government could possibly retain the figure that it had given in the interim budget or modestly revise it down. But we can also not rule out a modest cut to that figure because of the RBI dividend transfer that happened. Now, for more on the expectations of the budget and especially the signaling from the budget, given that this is the government's first one after its re-election and it does sort of set the tone for what to expect in terms of reforms as well as policy continuity for the next 5 years, I'm joined by Aurodeep Nandi, economist at Nomura, to share his views. Herein.
5 key themes, really. First and foremost, as you mentioned, this is the first budget of the government. This will be the first platform on which the government will be able to spell out its vision, its economic vision for the next 5 years. And also the medium-term fiscal consolidation path. So currently, the government of India's fiscal consolidation medium-term guidance ends in FY26, that is next year, where the ambition is for the government to reach a fiscal deficit of 4.5% of GDP. In fact, in the interim budget before the elections, the finance minister had said that the ambition is to exceed that target, so essentially below 4.5% of GDP. But what happens next, I think, is something that has yet to be spelled out. So first and foremost, I think the markets will be looking at the budget to get a sense of what the vision is, what kind of fiscal path is India looking at. The second aspect is really how this balances with the political side. We've seen reports of Andhra Pradesh, of Bihar, asking for packages, for flexibility to borrow more from markets, for help in infrastructure projects. And all of this would also mean that the government, on one hand, has to maintain its fiscal discipline, but on the other hand, has also needs to manage these political realities. The third thing I think which is going to be important is consumption stimulus. So consumption growth has been patchy, and the focus seems to be, just from news reports, that the government is looking to give some relief on income taxes. The PM Kisan, which is the handout which is given to farmers, that amount, reports say, could be increased by 2,000 rupees. There's also talk about more social sector spending in rural areas. So a consumption stimulus, so to speak, would be another thing to watch out for. On the flip side, the other thing to also look at is what the government is going to do on capital expenditure, right? So this is infrastructure spending. And one of the great things the government has done over the past a decade or so is ramp up central government spending on infrastructure, right? It's gone up in the I mean, at one point of time it was around 1.7% of GDP, almost double now to 3.4% of GDP. And this sort of feeds into both point number one, which is their economic vision, and also in terms of how the budget will look like, which is that is the government going to continue focusing so strongly on capex? And our sense is that they will. And in fact, we are penciling in 0.1% of GDP higher capital outlay than was there in the interim budget. So from 3.4, we expect 3.5% of GDP, possibly sort of more loans to states to do their infrastructure projects. So I think the focus on capex is going to be interesting to watch out for. And finally, I mean, manufacturing has been a mainstay of government policy for quite some time now. What they intend to do with PLI schemes, whether the government is looking to expand the scope of that, maybe to MSMEs, to labor-intensive sectors, maybe also the lower corporate tax rates, which sort of lapsed in March, whether they would be extended or not. So I think these are kind of the broad areas that will be on the radar of markets.
Okay, all right. Auradeep, I do want to understand. So you have outlined some of the key themes that the government might choose to focus on, be it manufacturing or its continuing thrust on capex or possibly higher spending on social sector schemes and a combination of that, right? So I do want to understand in terms of funding, are we looking at the higher than anticipated transfer from the central bank being able to fund some of these themes, or what will the government have to do on that? And also, in continuation to that, in terms of the fiscal math, from the interim budget to the full budget that's going to be presented, what is it that you think could change in terms of the key figures like fiscal deficit and what the government is going to target, and whether we could see a downward revision on that, and also in terms of its tax collections targets or its capex, are we expecting any change in any of these figures?
Okay. So let me merge the two questions, because I think they are essentially in the same direction, and trying to answer one would inadvertently end up answering the other two. So look, our headline view, as you alluded to, is that we are looking at the government possibly cutting its fiscal deficit target from 5.1% of GDP to 5% of GDP. Now, this is despite all the the various expenditure items that or the stimulus, income tax cuts, etc., that we are currently building in our simulations. Now, the question is, despite spending more on these items, how is it that we are saying that the government will still cut down fiscal deficit? Now, two things have happened since the interim budget. One, is that, as you mentioned,